Hi, and welcome to Life Health Exam Coach. And we are here to share with you the basic principles of life and health insurance. Hey, if you haven't checked us out already, go to lifehealthexamcoach.com and we will have a video there where you can see how you can sign up. We can help guarantee that you pass your life and health exam to become an agent as soon as possible. So, thanks for joining today. Let's jump in now to basic principles of life and health insurance. So first off, let's talk about types of insurance companies. There are commercial insurers, and these are also known as private insurance companies. This is what everyone thinks of when you think of, insurance company. They're selling insurance for a profit. They might specialize in a type of insurance, or they can sell many lines, which is another word for types of insurance. And they could be called multi-line insurers. So think of lines as different kinds of insurance, like life and annuities are a kind of insurance, health insurance, or property and casualty. In this series, we're going to focus on life and health. All right, this is an important fact need to know for the test. Commercial insurance falls into two main groups: stock companies you see here on the left, and then mutual companies on the right. So some of these concepts good to write down, get clear in your mind. Stock companies make profit for stockholders. Everybody's heard of stocks. Companies, have stockholders, and they are called non-participating or non-par. And what that means when you say non-participating is that the people who have insurance don't participate in the profits. Only the stockholders are the ones participating in profits from the company. So stockholders in that case in a stock company get dividends, which means getting some money or share of profits if the company is profitable. Those dividends are taxed. So the other kind of company that is not a stock company is a mutual company. Now this, as a policyholder, so a policyholder is somebody who has the insurance. So if I have an insurance policy, I'm a policyholder. And those are participating, meaning me as the policy owner, I get to participate in some of the profit as the company. So that's kind of nice, right? I can get dividends on those profits, or receive some money back in a sense, even though I'm paying for that insurance. Now those dividends are not taxed as long as they're just a return for the premium. So every policy that you get in the insurance world, you do have to pay uh, premium for. Well, I shouldn't say that. There are actually some exceptions in health insurance where you have $0 premium plans, but let's say most insurance policies you pay a premium for. Certainly in life insurance world, you definitely are paying a premium for it. And as long as you're getting the money back as just a return of premium, then those dividends are not taxed. In other words, you're not really making a profit on it per se. If you pay premium, you get kind of some of that money back, so that's why it's not taxed. So a mixed insurer is a combination. They're both par and non-par. So three concepts here: stock company, uh, which is a non-par; mutual company, which is par; and then a mixed insurer who has both par and non-par. In other words, they could have some stocks that they have and stockholders hold, but they also could have some policies that are participating that members or insurance policyholders can get some returns on. All right, let's look at strong assessment mutual company. That's a pretty long term, and these differ based on how they charge the premium. So there are two different ways. There's what's called a pure assessment mutual company. Pure means there's no premium up front. So assessment you can think of as, you assess the situation, you kind of look back and make an assessment, and they come up with a charge for that coverage based on companies' losses. So that could vary. So it's purely assessed based on performance. Now, an advanced premium assessment mutual company, you pay the premium up front. In other words, they're going to assess forward. They're going to figure out, what are our costs going to be? How much premium do we need to charge? And they're paid back, the policy owners paid back or charged more based on profit and loss. So it's, you're paying up front and then you kind of get a reckoning or, balancing that occurs in the end on those advanced premium assessment models. So think of pure assessment as, waiting to pay. And they look back and figure out how much you should pay on your premium. And advance means they're going to come up with a projected amount. They'll charge you that. And then, they'll do the actual reconciling at the end, usually end of the year. All right, another kind of insurance company is called a fraternal benefit society. And all of us are familiar with these, Knights of Columbus, Kiwanis, various fraternal benefit societies. These are a form of mutual companies. They are nonprofits. They make profit, but they have nonprofit status in terms of business, and they provide coverage just to their members. So there are some religious organizations that do this, and there are charities, as I said, like Knights of Columbus. So these fraternal benefit societies are, you can think of as a, coverage that's created for members. So they're really more about, covering the members rather than, of course, trying to, be a profitable business, because again, they have to be sustainable. So they do take money, but they're designed for the care of their members. Now, here's another concept called a risk retention group. And this is a group of people, usually an industry or profession, that band together. It's another form of mutual company. So, it is a par company. You think of professional organizations, maybe, lawyers, doctors, various industry professionals do this. So this group forms, together, and in a sense, they're creating insurance similar to what we talked about in the fraternal group, but in this case, it's, their common bond or the commonality is their profession. So it becomes a way of pooling money, pooling risk in a sense, as we talked about, in the last training, and called a risk retention group. So think of risk retention professionals retaining their own risk. In other words, they're taking care of the risk themselves by pooling their money together as a kind of large organization. So they take advantage of the fact that there's be quite a few members in the organization, and they're covering the risk, and that keeps their costs kind of low. Again, because the company doesn't have to make a profit per se, right? It's designed again for the benefit of its members primarily. Okay, service provider is another type of insurance company. Now you're going to see this more so on the healthcare side. Some of you may have heard of HMOs and PPOs. HMO is a health maintenance organization. PPO is preferred provider organization. That's why it's a little tricky to say. Uh, so these are two plans that have, in this case, they're health provider organizations that offer a health plan. So in a sense, that whole doctor organization, I guess, if you will, is providing a plan with benefits to what are called subscribers. So you should know that term. Service provider companies have subscribers. So me, if I, sign up for that HMO, I'm a subscriber. I'm subscribing to their plan and their benefits provided by those doctors, and in a sense, that network covered by that same group. So a little bit different structure there. And again, you're really only going to see this on the healthcare side of things. So good way to remember that. Think of, service providers, think of healthcare service providers. That'll help trip that memory. All right, next one, reciprocal insurers. Everybody knows what it means to be reciprocal, right? You're covering each other. So you're seeing some of that commonality in these different kinds of companies that we're talking about. So This is a similar kind of idea, a group of people that are insuring each other. So the difference here than, say the fraternal organization, if you will, or some of those other organizations that are, uh, covering a group too. The reciprocal, one thing to keep in mind you'll see on the test is it's an agreement of indemnity. They make an agreement of indemnity. Indemnity means they're protecting each other. And the other key thing that you'll see in reciprocal insurers you should know for the test is they use what's called an attorney in fact. So what that means is this, rather than it being a policy per se, they have an attorney write up their agreement together of how they're going to insure one another. So it's a very unique sort of situation. So again, to remember what's unique about reciprocal, reciprocal means, covering each other, and it has an attorney in fact on board that's, I guess if you could say sort of a referee or somebody who's helping make that work in a legal and fair sort of way. All right, reinsurers, we've talked about before in previous training. Reinsurance is insurance for insurance companies, and that's pretty important. Insurance companies, as you've learned, are carrying risks, and so they mitigate those risks. They protect themselves from having too much risk at once by purchasing reinsurance. So insurance insuring itself, that's why it's called reinsurance. And the reinsurer takes on the risk of the other ceding company. So the reinsurer is kind of the one that's, taking the risks now. The ceding company is another insurance company that's transferring their risk to the reinsurer. So think of the ceding company as the one that is, writing the policies with individual policy holders, and then the reinsurer is the one that's, above them, that's they're transferring the risk to that reinsurer. Okay, captive insurance is another important concept here. Insurance companies that are created and owned by a parent company to insure the parent company risks. And so this is very similar in a sense, to reinsurance, but it's all happening within the same company. So the example you see here is Physicians Insurance Company, is owned by a hospital, which is the parent company, and it offers insurance to physicians. So in this case, it's not really, in a way, it is technically a separate company, but it's all, within the same framework, or, combination of company and parent company, as opposed to reinsurance where it's, totally separate entity. These entities here, these businesses are related. So again, a physician insurance company is developed or owned by the hospital, and then it can provide that insurance to their own physicians. So that's what it means by captive. It's captive means it's holding its own. Is kind of the best way of thinking of what captive means. All right, here's another unique sort of insurance company. It's called home service or industrial. A really important thing here is do not confuse this with homeowners insurance. If you're a homeowner, you probably think of home service, you might think of something to do that's actually servicing your home. And it actually has nothing to do with your house whatsoever. It became known as home service because salesmen visit homes to sell. It's kind of like, door knocking. It's kind of the original sort of door knocking way of selling life insurance mostly. And so it is a form of life insurance. These are typically small amounts, and premiums are often paid weekly. So it's something that's marketed and sold. It's easy for people to buy. Somebody comes along, sells it to you, you can afford it. You can make those weekly payments. So think of home service or industrial as the agent doing the service in terms of selling a product affordable to people. Again, small amounts of life insurance typically that people can pay for. Next, we have government insurance, and I think most everybody is going to be familiar with this in one form or another. I think everyone's heard of Social Security. That's government insurance. It's a kind of insurance that was supposed to be guaranteed once you hit a certain age, protecting people in post-retirement typically. Medicare, many of you have probably heard of Medicare. It's a government insurance program for people over 65. Medicaid is another government insurance that's designed to help people with low income to cover health care costs. So again, all these are funded by the government. That's why it's called government insurance. And then finally, the last one there is TRICARE. And TRICARE is insurance that's for military, career military personnel. And again, it's a form of health insurance. So the last three there, Medicare, Medicaid, TRICARE, all forms of health insurance that are backed and paid for by the government. And so that's an important part of insurance. And we'll probably learn in other segments how so there are some mixtures of private insurance that can come in there, especially with Medicare. But we'll be studying that at a later time. For now, just know that there is government insurance. Okay, the next type of insurance company we want to cover is a self-insurer. And that simply means a company that uses their own money to cover their own risks. So, in a sense, they're not transferring any risk. So, that's what self insurance usually means. It means you're holding that risk yourself, you're retaining that risk yourself. So, a company has its own pool of assets, right? They fund their own plan. Now, they probably earmark it to cover specific things that they want to cover, maybe life insurance. Uh, it could be health also, and so they have a budget for it, but they're basically taking that risk themselves and putting that money aside out of their own profits in order to cover their own risks. So why would they do that? Well, it's of course saving them. They're not being charged any premium. Typically, these are only kind of companies that can do this. They have to have a pretty good amount of assets to be able to cover those sort of losses, right? So it's typically going to be a larger company that's able to self-insure, and they just calculate that it makes money for them financially. They calculate that risk is manageable for them, and that they're going to come out ahead by not transferring the risk, not having to pay premiums to cover everyone. So that's self-insuring. All right, we're going to shift now and talk about how insurance is sold. This is really important. This is what you're preparing and learning to do, right? So you're going to become an agent or a broker, and you should know the distribution systems is simply a fancy way of saying, how insurance products are sold. So there are agents and brokers like yourself and myself, producers. It can be captive or independent. And so we talked about, captive insurance, but a captive agent is an agent who is working for one particular carrier. So I was a captive agent myself at one point in my career, and I sold, for one specific carrier, I sold just their product. So I was captive. Uh, Independent means that you are not limited to one product line. And so, brokers are usually the ones, defined as somebody who is brokering means you're able to offer products from different carriers, different insurance companies, and multiple different sorts of lines of insurance. All right. And next concept you have there is that, or distribution system is a career agency, and this is created by an insurance company. So think of career agency. Who can set up a career for you? it would be an insurance company. So the career agency sets up office locations and they hire those captive agents. So what I just described, a captive agent situation is usually the organization is going to occur in a career agency. Now, a general agency is not created by insurance companies. So when you're making your notes here, career, just say, created by insurance company. General agency, it's not the insurance company that's created. Agents work for the agency. And again, they can usually represent multiple companies. But so an agent here is tied to that particular general agency. So next sort of organization is called independent agency. So in this case, an agent could actually work just on their own or under other agents, and they own their clients' accounts. In other words, it's not the general agency that's owning that book of business. It's actually the agents themselves or group of agents who own that book of business. So that's the major distinction there. Now, a managerial system is another distribution system. It's like the career, except the office is run by a branch manager. So it's set up as kind of managerial system, again, created by an insurance company. Rather than having a local agent run it, they create like a manager. So they have a management system who reports up into that company, into that insurance company. Mass marketing is the only system here that has no agents. And we see, one example of that maybe is you're looking at particular ads. You see ads for insurance on TV, and that company probably has some representatives that they have online on the phone, but they're not hiring agents. They just hire representatives who handle those direct sales to the consumer. So, in other words, they haven't created any distribution system. They're what I would think of as a kind of in-house way of selling. And so the agents, there's no agent whatsoever in that mass marketing system. Right, next here we're going to switch to industry regulation. There's quite a lot you need to know on tests for regulations. I know it's not the most exciting thing, but you've got to know these facts. So, tune in here. So this industry is regulated primarily at the state level. So that's an important fact to know. There's minimal federal oversight in insurance, and this is based on several different, shifts that happen legally in history. And you could see this, some of these names can show up on a test, so it's good to have some touchstone to it. Probably not going to ask you in-depth questions about these specific acts or laws, but you should have some recognition of those acts. They're called acts. These are laws that were passed. So the Armstrong Investigation Act, yeah, that gave the states the authority to be the regulation for insurance. In other words, this is the act that gave that power to the states. So think of Armstrong as state authority. Now, I like to try and remember things by keeping a few keyword phrases that helps me remember. McCarran-Ferguson Act. This is that the feds have authority to regulate, but they won't do so as long as the states do. So McCarran is kind of similar to Armstrong but there is some federal oversight, but McCarran-Ferguson is kind of deferred. Like, yes, there's federal oversight, but as long as the state's taking care of it, the feds aren't going to really step in much. The third one is not related as much at all. It is called the Fair Credit Reporting Act, and you probably all have, been made aware of this at some point in your life where you applied for credit and you got a report about, what your credit standing is. That act is important to insurance because insurance has to give that information, just like every industry knows now when you go to apply. If you're using credit, they can use credit reporting too as a way of sort of assessing risk in their potential clients. So as an applicant, your credit history, can have some bearing on whether you get accepted. So the Fair Credit Reporting Act, if they look at your credit, if an insurance company or any company looks at your credit, then they need to make sure that they're showing you that what they obtain and how they obtain it, and that it's done in a fair manner and accurately. So a couple of other acts here. This is three different names: Graham Leach Bliley, and that Financial Services Modernization Act simply allows financial companies to enter each other's lines of business. So you can think of it as a way, it's an act that allowed financial, and insurance is a financial company, banks are another kind of financial company. They're able to enter each other's lines of business, and so they can interrelate. So that's an important regulation that occurred. This last one occurred, the Patriot Act. I'm sure probably most of you have heard of that. It was designed, after 9/11 to prevent terrorism. Now, how does that relate to insurance? Well, one thing that terrorists can try and do is called money laundering. And sometimes they try and use insurance products as a way of laundering money, putting funds in that can then be extracted and not traced. So the Patriot Act applies to insurance. It is a way of protecting that kind of illicit, money laundering. So that's how it relates to insurance. Patriot Act says preventing terrorism by stopping money laundering. National Do Not Call Registry, I think probably most everyone has heard of that as well. Insurance businesses, just like all businesses, have to respect the Do Not Call registry. So if if the customer's on that registry, they are not they've requested not to be called. So that's important. A fair amount of insurance sales is done over the phone, and so of course you have to respect people's privacy if they've registered their number and don't want to be called. All right, the PPACA, mostly we just refer to that as ACA these days, the Affordable Care Act. This was a huge change in the health care industry, health insurance. It was an overhaul of health insurance regulations that occurred in the around 2010. Actually didn't go into effect until like 2016 or so. And well, some elements of it did, some didn't. But some of you may be aware of ACA, also known as Obamacare plans. These are actually government-backed insurance plans. So there's a whole lot to the Affordable Care Act. We don't have to get into it here. For the test, you won't really have to know in depth about it. Just know that it was a big overhaul of health insurance regulations, and enabled people, a lot more people, to get covered with health insurance. So that aspect of it was good. So keep that in mind. ACA, Affordable Care Act, making it made health insurance available and somewhat more affordable for people. You will, I'm sure, at some point on test come across the NAIC, and that's the National Association of Insurance Commissioners. This is basically the governing body of the insurance industry. There's commissioners in all 50 states, DC, and US territories as well. So these are the people, in a sense, that are in charge of making sure those. Remember, we talked about state regulations, state regulated, and these are the folks who are making those, guiding those state regulations, enforcing those state regulations. So they have these four goals. Don't know if you'll see these four goals exactly on the test, but good thing to know. They're encouraging uniformity in laws and regulations. So you'll see that even though there are state differences in the insurance industry, there's a lot of similarities too, because it's this commission is national, so a lot of the regulations are actually fairly similar. They do have differences, but a lot of them are similar. Of course, they all, that makes sense, right? They all have sort of the same goal, which is to protect consumers, make sure that they're getting products that are legitimate and fair. So they assist in the administration of those laws that are set up at the state level. And as I said, they're protecting consumers, policy owners, and they preserve, by doing a good job, right? They preserve that state-based approach to regulating the whole industry. All right, another industry regulation has to do with advertising. So this is important, right? We all know that advertising can be kind of misleading. And so the advertising code in the industry specifies misleading words or phrases that are banned from advertising. A lot of things in insurance, some of the words that you want to stay away from. Now, occasionally they are sanctioned, they're okay, like guaranteed. There are some things that are guaranteed, but it's very important not to use, at least in advertising, certain terms that are, can blow things a little out of proportion. This is the best plan ever. You know, the point of this advertising code is to make things, a little more even keeled and rational based rather than sensational. Insurance is an important product, and the point of this regulation is that it's represented fairly and accurately. So saying something's always going to work or this, will definitely, again, in certain contexts you can say that, but for advertising purposes, they frown on those kinds of, any kind of exaggerated or uh, blown up kind of uh, presentation. Unfair Trade Practices Act. This is exactly what it says. This is probably one of the easiest ones to remember. What are unfair trade practices? Well, anything that makes is misleading or unfair to a consumer. So again, regulation in all industry is designed for protection of the consumer from being taken advantage of. Remember that agents yourself, when you're educated. The industry knows what their products are doing. A lot of people don't. They don't understand how insurance is supposed to work. And so, insurance industry wants to make sure that people don't get taken advantage. You don't misrepresent information, don't give false information when you're selling. No, of course, unfair discrimination, and that can relate, to usually we think of discrimination can happen in many forms. We're well aware of main forms of discrimination, like maybe based on gender or race. But there's also in insurance other kinds of discrimination. You got to be careful you don't discriminate that based on a person's health or occupation. Don't assume somebody can't get coverage, things like that. So you know everything is designed to be as fair as possible to consumers. And so, along those same lines, there's a whole code of ethics that's the NAIFA, the Insurance and Financial Advisors National Association. Anytime you say NA, you always know it's National Association in this sort of context. So, National Association of Insurance and Financial Advisors, National Association of Health Underwriters are the ones that put together this code of ethics for the industry. One of the biggest ones, you'll hear this word and you should know this term, is suitability. What does suitability mean? It means the right product for the right person. Matching a product with that person's needs is suitability. So being ethical really means, choosing products that are suitable. They make sense based on that person. What are they trying to cover? And they're not, you're not selling somebody way more than what they need or giving them products that covering risks that they don't even have, right? So suitability means it makes sense for that person, it's covering a real need for them, and it's doing so in the right sort of way that's affordable and appropriate. Full and accurate disclosure, it means that you tell customers about the benefits and the limits of products. You will learn when you start diving into products. All of them have, some aspects of limitations, right? An insurance company can't cover everything for everybody in all cases. So, as a sales agent, it's important that you're disclosing what a product will do and also what it won't do so that people are clear. That's what full and accurate disclosure means. You're disclosing both the benefits and the limits. Another thing is kind of self-evident, document and service your accounts. You're not there just to write a policy and not take care of people. If you're there to help support them, make sure they know how to utilize their insurance that you've gotten for them. There is what's called a buyer's guide. You should know that term, buyer's guide. It's required information to give to consumers. It's general information about insurance products. For example, in life insurance, a buyer's guide is going to give you an outline of the different kinds of options there are. And then the policy summary is a more specific document, giving actual plan information from that policy. So, summarizing the benefits and those limitations for them. So, buyer's guide gives them that general overview, and policy summary is giving them specifics of the product that you are selling to them. All right, so some other terms that you need to know here, a little more random, they're not in one category. When it comes to knowing insurance business, insurance companies, regulations, one of them is called reserves, and you might have heard of this before. It's reserves, exactly what it sounds like. It's money that's set aside to pay future claims. So insurance companies have to do that. They have to, uh, have money allocated or earmarked for paying future claims. They can't run by the seat of their pants in a sense. Like, oh, we got money today, but hopefully we don't get too many claims next week because the pot's getting a little thin. They've got to have a bank there that have reserves to make sure they're able to cover those future claims. So there's laws around that. There's regulations around that. Liquidity means money to pay unexpected claims. So it's similar to reserves. Somebody's liquid, right? They've got funds they can grab. So in a sense, you say the reserves are covering sort of what is expected, and liquidity means that they also have, the ability to cover the unexpected as well. All right, guarantee associations. These are protections for insured people in case the insurer is not